Welcome. Let me start with a question. If you leave the money in your bank account untouched today, do you think you'll be richer or poorer 1 year from now? Most people say nothing happened. I didn't do anything. But here's the truth. Doing nothing is still a decision, and every decision has a cost. In this video, we'll talk about why money shrinks when it doesn't work, why simply saving money doesn't protect you, and how money is actually a game with rules. If you're ready, let's begin. Chapter 1. The loss of money's value over time. There is one more important thing you need to know about money. Over time, money loses its value because of something called inflation. In 1913, the price of 1 gallon of milk was about 36 cents, while in 2013, the price rose to $3.50, increasing almost tenfold. Chapter 2. Inflation rate and the savings problem. Most countries usually target an annual inflation rate between 2% and 2.5%. This figure shows how much the money you save loses value each year compared to other currencies, meaning that keeping all your money in a bank account or under a mattress becomes a problem over time. And this is where the concept of investing comes in, using money that would otherwise lose value by doing nothing to earn more money and beat inflation. Chapter 3. The question of the stock market. You've probably heard that one of the easiest ways to invest your money is through the stock market. But what exactly is the stock market? Suddenly, we are faced with many unknowns. How do you start investing? And is it really the investment tool people want you to believe it is? Let's examine this topic together with examples. Chapter 4. Markets and the economy. After the worst week since the financial crisis, the market reopened. Funds and hedge funds, investment funds that trade relatively liquid assets and frequently use complex financial strategies such as short selling, leverage, derivatives, portfolio construction, and risk management techniques, rose 200 points at the opening this morning. It looks like a great place to put your savings. Suddenly you put everything together and say, wow, is it really this easy? Chapter 5. What is a market? A market, simply put, is a place where things are bought and sold. If you live in one of the world's major countries such as the United Kingdom, the United States, or India, your economy largely depends on many different markets. For example, the car market deals with buying and selling cars, the real estate market deals with buying and selling houses, and the stock market deals with buying and selling shares. Chapter 6. What is a stock? This naturally raises the question, what exactly are stocks? A stock is a security issued by a company that represents ownership equity. When you invest in a company, you also gain the right to its profit share, also known as dividends. So in addition to benefiting from the increase in the company's value, you also receive a share of its profits. Simply put, a stock represents partial ownership in a company. Chapter 7. Company ownership and going public. For example, if company X is divided into 10 shares and the founder owns all 10 shares, they own 100% of the company. If the founder owns 5 shares, they own only 50% of the company, and so on. In financial terminology, people who own shares in a company are called shareholders. But this raises a new question. Why would a business owner or founder decide to sell shares of their own company? Imagine that you own your own business, a grocery store. Business is going well. You have the best products in the area, and sometimes customers are literally lining up at the door, but you have much bigger goals. You truly believe your company and products are the best in the industry, and you want to expand your business. You want to open more locations, hire more staff, and maybe even go global. Your team runs larger marketing campaigns, but doing this creates additional costs, meaning you need to raise more capital. You could go to a bank and take out a loan, but that means paying interest, and the bank might even reject you if they consider you too risky. Therefore, another way to raise capital is to issue or sell shares of your company. You can do this privately by selling shares to trusted friends who believe in your business, or publicly by selling shares to anyone who wants to buy them. This is done through a special event called an IPO, initial public offering, which turns your private company into a public company. Part of going public is deciding how many shares you want to offer, which is usually referred to as the share offering. The initial value of each share depends on how financially healthy your company is, how similar businesses are performing, and how much demand there will be for your shares when they go public. As a result, along with many other factors, publicly traded company shares begin trading on the stock market. Chapter 9. Buying and selling stocks and order types. So how does a stock exchange work? An investor or company founder first goes to a brokerage firm to buy or sell a stock, placing an order similar to ordering Tesla shares. This order includes several details. First, you must specify the company whose shares you want to buy or sell, usually represented by a stock ticker symbol. For example, Apple, AAPL, Intel, INTC, Amazon, AMZN, Tesla, TSLA. You can easily find the company's ticker symbol on Google. Next, you specify whether you want to buy or sell. Then you choose the order type. The stock market can be thought of as an auction market. Thousands of buyers place bids while thousands of sellers demand specific prices. When a buyer and a seller agree, a transaction occurs millions of times a day as prices fluctuate. One order type is a market order, which tells your broker to buy or sell at the current market price. Another is a limit order, which sets a minimum price for selling or a maximum price for buying. The risk is that the stock may never reach your specified price. There are other order types such as take profit orders, conditional orders, and chained orders, but market and limit orders are generally considered the most important. After choosing the order type, you specify how many shares you want to buy or sell, and that's it. In the past, this was done via written mail or physical stock certificates, later by telephone. Today, most brokers operate online or through apps, making trading faster and easier. Stocks have transitioned from physical certificates to electronic records, making investing much more accessible. Chapter 10. Investors, strategies, and expectations. Now the question is this: how will you, the viewers of this video, use all this information to make the right investment decisions? Pause the video here and discuss what we've learned so far in the comments. What do you think? I'm curious about your ideas. And don't forget to like and subscribe. There are different players in the investment game. You often hear the terms retail investor and institutional investor. Retail investors are individuals like you and me, investing smaller amounts for personal accounts. Institutional investors are the major players: pension funds, investment funds, hedge funds, banks, who invest large amounts on behalf of clients. These institutions usually have analysts who constantly study the markets. However, this video focuses on small-scale retail investors like you and me. The goal is to make money by buying stocks at a lower price and selling them later at a higher price. But to do that, you must know which stocks will rise and which will fall, and when. Stock prices are highly volatile and largely depend on supply and demand. If Apple releases positive news about an upcoming product, confidence rises, demand increases, and prices go up. However, markets are highly unpredictable. Stock prices can be affected by CEO changes, product quality, government policies, or even industry popularity. For the average retail investor, it's difficult to keep up with all these variables, which is why long-term investing is generally better than short-term investing. Long-term investing means buying stocks and holding them for a long time. Warren Buffett, known as the Oracle of Omaha, is famous for his value investing strategy, where he analyzes fundamentals, assets, liabilities, and book value to find undervalued companies. Short-term investing, by contrast, often involves holding stocks for less than a day and is extremely risky for most investors. Most people prefer passive investments that require less time and energy. This is where indexes come in. Indexes measure the performance of selected stocks and give us insight into overall market performance. For example, the Dow Jones Industrial Average tracks 30 major US companies, while the FTSE 100 tracks the top 100 companies in the UK. Now imagine investing in all these companies at once. This is where index funds and ETFs come in. For example, the Vanguard S&P 500 ETF includes all companies in the S&P 500 index, allowing you to invest just like buying a regular stock. This means your money is spread across 500 companies at once, providing diversification without extra effort. Another advantage is that when a new company enters the S&P 500 index, it is automatically added to the ETF. Many personal finance experts recommend ETFs like the S&P 500 for long-term investors because they are relatively safe and passive. However, the real question is, how much return do you expect from the stock market? We are currently in a bull market where prices generally rise, but market crashes are inevitable and often unpredictable. In most cases, long-term investments yield an average annual return of 6% to 10%. This may not sound glamorous, but the stock market should not be seen as a quick way to get rich. Long-term investing is a game of patience. Be cautious of people or companies promising high guaranteed returns. With apps like Robinhood or Webull making investing easier than ever, many retail investors enter the market without proper research. Some important warning: you'll often hear the phrase buy the dip. While it can be annoying, investing is driven by emotions. When prices rise, fear of missing out can lead to bad decisions. In reality, prices dropping is often the best time to invest. Money is made during downturns. Only invest what you can afford to lose. A common recommendation is to invest about 10% of your income each month. Do not panic and sell when prices fall. If you're investing long-term and your portfolio is well diversified, short-term ups and downs don't matter. You don't actually lose money unless you sell. Finding a good brokerage firm is often as easy as a simple Google search. Just make sure to verify it. Now I know this video focused on strengthening your understanding of the stock market. I've always believed that when you truly understand the foundation of a subject, you can better grasp its deeper detail.